Welcome to today's Explainer. We're jumping right in today because we've got a massive topic. We are unpacking the cinematic nickname of today's absolute financial heavy hitters, the Magnificent Seven. If you've glanced at the stock market over the last few years, you've undoubtedly felt their impact. But today, we're going to break down exactly who they are, why they've dominated the past decade, and what the real risks are. Let's get started. Okay, let's dive into this. Just look at this breakdown. By the end of 2024, these 7 companies, just 7, made up roughly a full third, 33% of the entire S&P 500's total market capitalization. I mean, think about that for a second. 7 companies carrying the weight of a third of an index that tracks 500 of the largest U.S. companies. The other 493 companies had to share the remaining 2/3. So here's our roadmap for today. First, we'll meet the Magnificent Seven. Second, we're unpacking their track record. Third, the pros of big tech. Fourth, we'll look at the risks and drawbacks, getting a truly objective look at the concentration risks here. And finally, number 5, how to actually invest. All right, part 1, meet the Magnificent Seven, the heavy hitters of tech. As we just saw, their weight is massive, and in 2025, these specific companies drove more than 40% of the S&P 500's total return. That is a staggering concentration of market power driving the index forward. Now, as a quick refresher, you'll constantly hear these referred to as large cap stocks. All that really means is these are corporations with enormous market capitalizations. You just take the total number of a company's outstanding shares and multiply it by each share's current value. Basically, it's the total price tag of the entire company. So who actually carries this massive price tag? Well, here's the roll call of the giants. We've got Alphabet, Amazon, Apple, Meta Platforms, Microsoft, Nvidia, and Tesla. Literally every single one of these companies has at some point hit $1 trillion valuation. And by early 2026, 3 of them had actually topped $4 trillion. $4 trillion! They are the undeniable titans of the modern technology sector. And you might be wondering why this specific nickname. Well, it's actually a direct nod to the classic 1960 Western film, The Magnificent Seven. They earned this gunslinger title back around 2023 because they basically rode in and rescued overall market growth when a lot of other sectors were really struggling. Moving on to part 2. Unpacking the track record, a decade of dominance. We're going to shift gears and look at exactly how much these individual companies have grown over the past decade, leading right up to February 2026. Looking at Fidelity data here, this is up to February 25, 2026. The contrasts are just wild. Take Apple, the very first of the group to go public way back in 1980. They're showing a steady, massive 10-year growth of over 1,000%. Then compare that to Amazon. They evolved from just selling books online into this giant buy-everything model, plus cloud computing and streaming, which fueled an incredible 650% rise over that exact same decade. Now, what's really interesting about this next number is, well, let's just pause for a second to really take it in. 24,345%. That is Nvidia's truly absurd standalone 10-year return. The chipmaker saw its stock completely skyrocket to levels that far, far outpaced anything else in this magnificent group during that time. And then, of course, there's the unique outlier of the bunch, Tesla. They are an automaker producing electric vehicles, solar roofs, home energy generators. They sit right alongside traditional tech companies that just specialize in software, search engines, and social media. But here's the thing, the market and investors treat Tesla very much like a tech stock. And that exact sentiment helped it surge over 3,200% over that same 10-year window. Which brings us to Section 3, the pros of big tech, why they lead the market. We've seen the unbelievable numbers, so now we have to ask the fundamental question. Why? What are the underlying reasons these 7 companies are so incredibly dominant? Well, the foundation of their success really comes down to 3 main pillars. First up, financial strength. These companies historically have immense operating resources, huge profits, and incredibly strong track records of revenue growth. Second is market leadership. They enjoy massive customer loyalty. And their sheer size, it's like a fortress, insulating them from new competitors trying to break into the space. And finally, global operations. By operating and selling all over the world, they diversify their revenue sources and perfectly position themselves to capture growth in rapidly developing international markets. But it's time for a grounding pivot. Section 4, risks and drawbacks, the counterweight. Because as exciting as those historical numbers are, we've got to be measured here. Past performance absolutely does not guarantee future returns. The counterweight to massive growth is massive expectation, and with that comes real risk. You see, these giants are what we call mega caps, meaning they boast market values of $200 billion or more. But here is the sheer brutal math of this situation. It is vastly more difficult for a massive company to double its value from, say, $3 trillion to $6 trillion than it is for a smaller company to go from $3 billion to $6 billion. Assuming their past explosive growth is just going to effortlessly continue forever is mathematically dangerous. Furthermore, these stocks carry premium prices. And what does that actually mean? It means high investor expectations of future massive growth are already baked right into the current price of the stock. Because they are basically priced for perfection, they're highly vulnerable to volatility. If even one of these giants misses those lofty growth targets, the stock value can take a sudden and really serious hit. So the crucial point is right here. Be careful not to put all your eggs in one basket. This highlights the whole concept of portfolio concentration. If you heavily invest in just these 7 companies and the tech sector hits a rough patch, your entire portfolio takes the brunt of that impact. That's the elevated risk of having so much concentration in one place. All right, our final section, Section 5, how to invest engaging with the Magnificent Seven. If you've weighed the pros and cons and decided you do want to interact with these assets, how do you actually go about it impartially and effectively? There are 3 primary ways to do this. First, you could just buy the individual stocks through a brokerage or retirement account. Second, you could buy shares of an index fund, like the S&P 500 or the Nasdaq Composite, which inherently track the broader market. Or third, you could buy shares of a specific Magnificent Seven ETF. But again, please carefully weigh those concentration risks we just talked about before making any moves. And just to clarify, if you do opt for index funds, you're essentially buying into groups of securities that share a specific feature, like being high-value companies or belonging to a certain sector. Both index funds and ETFs give you that broader market exposure by letting you buy into a whole basket of companies at once. Just remember, if you go the fund route, always watch out for the expense ratio. That's the percentage of your overall investment that goes straight to paying the fund manager. As we wrap up today's explainer, I want to leave you with a thought. Are the Magnificent Seven already in your portfolio? Because the fascinating truth is, if you hold a broad, large-cap index growth fund, or even just a standard retirement account, you very likely already own a piece of these gunslingers without even realizing it. So I highly encourage you, go check your own retirement accounts today and see exactly how much exposure you already have. Thanks so much for joining me to unpack all this data today, and keep learning.